It started with a sentence that sounded harmless enough to put on a coffee mug. Home ownership is the foundation of the American dream. Turns out you can build a foundation out of almost anything. Sand, false promises, other people's retirement funds. Nobody checks until the house is already collapsing. The dot-com bubble just finished detonating in everyone's retirement account. The country got punched in the gut on September 11th and hasn't fully exhaled since. What America needs, according to absolutely no qualified economist, but somehow everyone in charge, is a fresh new thing to gamble on. The Federal Reserve steps in like a parent who just found out their kid is sad, and instead of therapy, buys them a credit card. Interest rates? Let's just take those down to almost nothing. This is the financial equivalent of telling a raccoon the trash cans are now unlocked. Borrowing money becomes so easy it stops feeling like debt and starts feeling like a coupon. You're approved. $500,000. I make $40,000 a year doing inventory at a hardware store. Doesn't matter. We've got a product for you. It's called an adjustable rate mortgage. Low payments now, and in 2 years it adjusts. Adjusts to what? We'll cross that bridge when several million other people are also standing on it. There's a name in the industry for loans given to people with no verified income, no job, and no assets. They call it a ninja loan, which is a genuinely upsetting choice of acronym for an industry that was, at the time, sneaking up on the entire global economy. Somewhere, in an office with fluorescent lighting, a federal regulator is reading a memo about all of this. He finishes a memo. He puts it in a drawer. That drawer will not be open again until roughly 2009, by which point it will not matter. Homeownership wasn't just shelter anymore. It got promoted. Billboards, late-night infomercials, mortgage brokers working out of strip malls next to nail salons, all repeating the same idea until it stopped sounding like a sales pitch and started sounding like a fact of nature. House prices only go up, which is a strange thing to believe, given that literally nothing else in human history has only ever gone up, except maybe the price of funerals. And even that has competition now. Guy 2 doors down just flipped his house for double what he paid. Didn't even fix the leaky roof. Good for him. Down payments, once considered load-bearing, became optional, like seatbelts in a car commercial. Lending standards, once treated as a safety mechanism, got treated instead like something that was cramping everyone's style. You had a pulse. Congratulations, you had a mortgage. The people writing these loans weren't doing it because they believed in the borrower's future. They were doing it because the loan wasn't going to be their problem in 6 months. It was going to be someone else's problem, wrapped in a bow, 3 transactions down the line. Nobody used the word bubble out loud yet. Bubbles are only obvious in hindsight, and in fairness to everyone involved, hindsight hadn't been invented yet in 2003. By 2005, the American dream had quietly rebranded itself as a get-rich-quick scheme wearing a nice cardigan. I sell insurance during the day. At night, I own 4 condos I've never set foot in. What happens if the market turns? Why would you even ask me that? This wasn't investing anymore. This was a countrywide game of hot potato, except the potato was on fire, made of debt, and everyone kept insisting it was actually solid gold if you just looked at it from the right angle. Underneath the granite countertops, the loans themselves were rotting in real time. Not need some work, rotting. Structural, load-bearing. Please do not enter this building rotting. So Wall Street did the only sensible thing you can do with a pile of bad debt. They got creative. Take 1,000 of these loans, the shakiest, most barely verified mortgages you can find. Chop them up, mix them together into one giant financial smoothie, and sell slices of that smoothie to pension funds and city governments as a completely safe, stable investment. This is called a mortgage-backed security, and it is structurally the same trick as hiding a vegetable inside a brownie, so a child will eat it, except the child is a Norwegian pension fund, and the vegetable is a subprime mortgage held by a man who is currently 3 months behind on payments and does not know it yet. And to sell a brownie full of vegetables, you need someone respectable to vouch for it. Enter the credit rating agencies. The people whose entire job is to look at a pile of debt and tell everyone else how safe it is. This bundle includes loans made to people with no income, no job, and one guy who financed a boat he cannot legally operate. Sounds airtight to us. AAA rating. Same grade as U.S. government debt. Here's the darkly funny part. And I do mean darkly. The rating agencies were paid by the same banks whose garbage they were rating. It's less conflict of interest, and more like paying your own obituary writer in advance, and specify which adjectives you'd like used. Nobody who understood what was in these bundles said anything. Understanding, at this stage of the crisis, had become a liability. Ignorance paid better, and came with a bonus. Then Wall Street did again, but worse. Took the already questionable mortgage bundles and blended them a second time into something called a collateralized debt obligation. Garbage, repackaged as more garbage, rated as gold, sold as safety. It's financial taxidermy. Something that died a while ago, stuffed and posed to look like it's still breathing. Not everyone bought the act. A small number of investors actually read what was inside these things and had a fairly reasonable reaction. Horror. This is going to collapse. We want to bet against it. There wasn't a product for that yet, so they built one. Insurance contracts that would pay out if these mortgage bundles failed, called credit default swaps. The twist. You didn't need to actually own the mortgage bundle to buy insurance on it, which is a bit like being allowed to take out a life insurance policy on a stranger's grandmother, based purely on the observation that she looks a little tired lately. Wall Street sold this insurance by the truckload, collected the monthly premiums, and quietly assumed the thing they were insuring against would simply never happen. This is, historically, the exact posture people take right before the thing happens. By now, the entire financial system is a tower built out of debt stacked on debt stacked on debt, each layer a little shakier and a little more confidently labeled completely safe than the one below it. And at the very top of that tower, another record bonus year, gentlemen. To us. Regulators are still in that drawer. Whistleblowers are filing reports that get filed, in the literal sense, into other drawers. The tower keeps growing. Nobody looks down. For a while, the cracks are small enough to ignore. A missed payment here, a foreclosure sign there, a brand new subdivision in the desert outside Phoenix. Fully built, fully wired, fully empty, a monument to a very specific kind of confidence. Then, in 2007, home prices do something they were contractually, spiritually, and mathematically not supposed to do. They fall. Prices don't fall. That's not. Housing doesn't work that way. It does now. The subprime loans start defaulting, and the mortgage-backed securities built on top of them stop being completely safe investments and start being what they always were underneath the paperwork. Garbage, now confirmed, in writing by reality itself. Banks that had spent years being told they were holding gold discover they are, instead, holding something closer to radioactive waste. Expensive to keep, impossible to sell, and actively dangerous the longer anyone holds on to it. We can't sell this. Nobody's buying. The market for it just evaporated. So what do? We find out how bad this actually is, together, in public. And then, the big one, Lehman Brothers, a firm that survived the Great Depression, 2 world wars, and several decades of its own executives' questionable haircuts, collapses in a single weekend with no rescue, no buyer, and no soft landing. $600 billion gone, the largest bankruptcy in American history, announced on a Monday morning like a particularly grim weather report. The unspoken message to the rest of Wall Street lands instantly. If a 158-year-old institution can die overnight, nothing is safe. Certainly not you. Banks stop lending to each other completely, which sounds like a small, boring, back-office kind of problem until you realize the entire global economy runs on that exact plumbing. Credit freezes. It's less a slowdown and more like someone reached behind the wall and pulled every wire out at once. We need a short-term loan just to make payroll. There's no liquidity. Nobody's lending to anybody. So what happens to payroll? Payroll doesn't happen. The damage stops being abstract almost immediately. Families who never missed a payment discover their home is now worth less than what they owe on it. A strange kind of debt where you can do everything right and still end up underwater, quite literally, in some cases. 401k. Lose a third of their value in months. People who were 6 years from retirement quietly recalculate that number to something much larger and much sadder. Unemployment climbs toward 10%. Foreclosure notices pile up faster than anyone can process them. In some cities, entire blocks empty out at once, like the neighborhood itself had been foreclosed on. And it doesn't stay in America. Iceland's entire banking system, not one bank, the whole system, collapses within days. Stock markets in Tokyo, London, and Sao Paulo fall in near-perfect unison, like dominoes that had, without anyone noticing, been quietly wired together the entire time. The question stops being which bank is next and becomes something considerably worse. Is there a floor under any of this at all? The U.S. government is left with a genuinely miserable choice. Let the whole financial system collapse, or hand an enormous amount of taxpayer money to the exact institutions that built the collapse in the first place. We need $700 billion. For what? To keep the banks from failing. The same banks that, yes, those ones, they go with a bailout. It's called TARP, the Troubled Asset Relief Program, which is a very tidy government name for we are buying back the garbage we just found out is garbage at something close to the price everyone paid before they knew it was garbage. The logic is that these banks are too big to fail, a phrase that, translated honestly, means these institutions grew so large and so tangled into everything else that letting them collapse on principle would mean taking the rest of us down with them out of spite. So nobody gets to have the spite. AIG, an insurance company that had somehow sold trillions of dollars of protection against exactly the scenario without setting aside nearly enough money to pay any of it out, receives about $180 billion. GM and Chrysler, car companies worth noting, not banks, receive roughly $80 billion of their own, because by this point the entire concept of who deserves a bailout has become somewhat improvisational. Meanwhile, the Federal Reserve slashes interest rates to nearly zero and begins buying up trillions of dollars in bonds and mortgage debt directly, a process with the deceptively boring name quantitative easing. It is, in effect, printing money to patch a hole that money itself helped create, treating the wound with more of what caused the injury, and hoping the body doesn't notice. It mostly works, in the narrow sense that the system doesn't fully collapse. Markets stabilize by 2009. The stock market starts climbing back. Executives at the rescued banks receive bonuses again, some within the same year their firm was rescued by public money. Meanwhile, roughly 8.7 million people lose their jobs. Around 4 million families lose their homes. $19 trillion in household wealth disappears. Not at any one person, just gone the way it is when a currency of trust stops being honored. They're getting bonuses again. I got a foreclosure notice. Right, but see, those are two unrelated things happening to two unrelated groups of people. Nobody senior actually goes to prison. Not one major Wall Street executive is ever criminally convicted for their role in building a machine that did this. Some firms pay civil fines, tens of billions combined, which is a bit like a company being fined for arson using money it made from the insurance payout on a fire. In 2011, people gather in Zuccotti Park in New York with tents and cardboard signs, and the message on the signs is short enough to fit the mood exactly. We are the 99%. It isn't really about the bailout money by then. It's about the very simple, very unfunny discovery that the system had two different sets of consequences. One for people who are, technically, systemically important, and one for everyone who is not. The tower didn't just fall in 2008. It got quietly rebuilt afterward, with most of the same architects, using most of the same blueprints, minus a few of the more embarrassing flaws. If 2008 taught the world anything, it's that the next crisis rarely looks like a crisis on the way in. It looks reasonable. It looks profitable. It looks, for a good long while, like the smartest thing anyone in the room has ever done, right up until the room isn't there anymore. If you enjoyed this one, subscribe for more, and tell me in the comments which collapse you want covered next.